Hello, and thank you for tuning in to the Waterfront Asset Management Economic Update. I wanted to start by going briefly over the consensus outlook for economic growth and some key economic statistics before spending the rest of my time talking to you about why my outlook is meaningfully different, and close with some outlook commentary for both equity and fixed income markets. So with that, let's start with that first slide, which just shows you some consensus forecasts that were taken from a Bloomberg News survey of 70 or so economists conducted during the month of January. In the summary of this slide, there are a lot of numbers. I'll leave it to your own time to review those if you care. But the summary of this slide is economic growth as measured by GDP is expected to slow, with the industrialist side of the economy actually in contraction by the back half of 2023, again, using consensus estimates. Inflation is expected to slow or cool from elevated levels today to more meaningfully lower levels, particularly by 2024, with a modest increase in unemployment and a Fed funds rate or an interest rate dynamic that on the short end is relatively static in 2023, but markets are anticipating that the interest rate term structure will change dramatically in the intermediate term, and that's shown by the consensus forecast of the 10-year Treasury yield being at 3.4%, while at the same time Fed funds are expected to be 5% by Q4 of 2023. So clearly markets are anticipating that the Fed will be cutting interest rates in the intermediate term. If we go to the next slide, I would describe the current market today as one that has a lot of push and pull kind of dynamics. And I've shown to show that on this slide by looking at two significant parts of our economy: the services part of the economy and the manufacturing or industrial side of our economy. Many of you are familiar with riptides or rip currents. As waves crest and hit the beach, water recedes back into the ocean, creating a current that kind of has a circular motion to it. And as you know, if you've done any kind of swimming in the ocean, rip currents can be hazardous. And today, our economy has some of those same characteristics. For reasons that often are quite often are related to the pandemic and the impacts that it had on the way we spend and on the way we behave, both as consumers and as companies, the services side of our economy is extremely strong, as shown by the Purchasing Managers Index level of 55.2%. And you can see that it's been strengthening. So the services side of our economy, to include things like airfares and restaurants and bars and concerts, is doing exceedingly well today. At the same time, the manufacturing and industrial side of our economy, as measured by the Purchasing Managers Index, has been in decline for over a year and actually is in contractionary, or you could say recessionary levels. So why is that happening? A lot of that is due to the fact that during the pandemic, governments here and around the world inflated their economies, pursued easy monetary policies, including sending checks and offering low or no interest loans to consumers and businesses in order to help them deal with the economic impacts of the pandemic. Because consumers weren't able to spend that money on services because they weren't allowed to move freely about the country, as our Southwest Airlines friends like to talk about. And so they spent that money on goods. And so the manufacturing and industrial side of our economy boomed. As we've moved from the pandemic phase to the more of an endemic phase, we're learning to live with COVID-19. Consumers are now able to travel. They're now able to attend concerts. They're now able to go out to restaurants and bars. And so the services side of our economy, after struggling through most of 2022, has boomed in the back half of 2022 and continues to be very strong and strengthened here in 2023. Those impacts, or that dichotomy, creates confusion in the outlook. If you turn to the next slide, you can see one of the ways, or one of the areas where that confusion is showing up, is in the outlook for inflation. On the left-hand side of that chart, you'll see the CPI index going back over 70 years. And you can see two things. One, obviously, we were at very elevated levels relative to almost any time in history over the course of the last 24 months. And you can see that the inflation rate peaked in 2022 and has started to slow. On the right-hand side of that chart is another chart that was put together by JP Morgan that looked at market implied inflation rates into the future. And you can see with that orange line that the market is anticipating a dramatic decline in inflation for this year, and then a sort of asymptotic or flat trajectory for the foreseeable future, right around 2%, which is the Fed's target. I'd point you, though, to an interesting difference, which is the expectation of the Federal Open Market Committee, which is the committee that sets short-term interest rates. This is the Federal Reserve. They expect inflation to cool, but not at the same pace. And that's creating confusion in the market's expectations for not only the outlook for inflation, but on an associated basis, the outlook for interest rates. It's also showing up in the outlook for economic growth. I'd point you to the next slide, which shows two leading economic indicators. Obviously, markets are forward-looking vehicles. We're not as concerned about where things are today. We're very focused on what will be happening over the next 12 to 18 months. And so we spend a lot of time thinking about and trying to find indicators that help us anticipate changes in the economic outlook. Two of those I've listed on this chart. The first is the Conference Board Leading Economic Index. On the right-hand side of that chart, you can see that composite of leading indicators has been in decline for the last 12 to 18 months. And just in the last quarter or so, fell to a level that is indicative of a recession that will be coming in the future. Historically, the Conference Board Leading Economic Index, the composite of indicators, tends to peak 15 months prior to the onset of a recession. The most recent peak in that composite indicator was in Q3 of 2022, suggesting that the US economy, if that relationship were to hold, would be in recession in the third quarter, middle part of 2023. Another indicator that markets often look to anticipate changes in the outlook for economic growth is the yield curve. And I've shown that relationship on the left-hand side of this chart. This is looking at the yield differential between the 2-year Treasury note and the 10-year Treasury note. And in periods of normal economic conditions, that relationship is positively sloped. In other words, the 10-year interest rate is higher than the 2-year interest rate. As you can see on that chart, in periods of recession or immediately prior to recessionary time periods, that relationship inverts. The 2-year Treasury note has an interest or a coupon that's higher than the 10-year Treasury. And the reason why that happens is markets move faster than regulators. Markets anticipate the fact that the interest rate environment will have to change dramatically in the future. And so the interest rate that they're willing to take on 10-year Treasury notes declines well below the interest rate in the market for 2-year Treasury notes. This indicator is one that economists and strategists have used for many, many, many years. This relationship you see on this chart dates back 70, 80 years, and it's been a consistent leading indicator. It tends to invert about 15 months prior to the onset of recession. And the two things I'd point out to you on this chart are, one, clearly the inversion is significant relative to history. We haven't seen an inversion that reaches this depth since the late 70s and early 80s, a time period that probably not incidentally was also associated with elevated levels of inflation. But second, I'd also point out that that inversion started on April 1st of 2022. So again, using the historical relationship of this leading economic indicator to the onset of inflation or onset of recession, which typically is about 15 months, would suggest that the middle part of this year to the back half of 2023 is when you would reasonably expect an inflation, a recession to occur. So this confusion, this undertow or riptide in our economy creates confusion, and that confusion has consequences. And I point you to the next slide as a to detail one of those consequences. This is a survey that's done by the Federal Reserve Board of Governors of domestic banks, and it asks questions to the senior loan officer survey of those banks. Sorry, the senior loan officers of those banks, and asks them about their willingness to lend to consumers and to corporations. And it asks them whether they're tightening credit standards, making it harder to get a loan, or loosening credit standards, making it easier to get a loan. And as you can see on this chart, starting in the third quarter, and really it was more the fourth quarter of 2022, the senior loan officers in this survey collectively were reporting a significant increase or a significant tightening in credit standards that they were requiring in order to lend money. This uncertainty in the economic outlook, this push and pull, has created an environment where banks are starting to pull back, pull away from risk. Historically, once banks start to tighten credit, within 2 quarters, our economy is in recession. If you flip to the next chart, I want to highlight the fact that some of this is old news. As you all are probably very well aware, the S&P 500 ended 2022 down 18%. And a realistic or reasonable question to ask me at this point in our presentation is, yeah, okay, well, we all know about this. Recession has been in the headline news for some period of time. And I want to point out 2 things on this chart. The first is recessions happen. It's a normal part of the economic cycle. And the second thing I want to point out is that on average over time, bull markets have lasted about 5 years. You can see that in the commentary of this chart. And the cumulative total return in a bull market is meaningful. Bear markets tend to be relatively short. On average, they're about 1.5 years. And on average, they post a cumulative loss of about 35%. As I mentioned, last year, the S&P 500 was down 18. I want you to keep in mind that down 35% in an average bear market as we flip to the next chart, which is an overview of the equity market looking through 2 lenses, earnings and the multiple that investors are willing to pay for those earnings. On the left-hand side of that chart is an index or is a picture of the performance of the S&P 500, and charted in the solid blue line, darker blue line, is earnings for the constituents of the S&P 500. As you can see, earnings have topped out for the S&P 500 and have started to roll over. And if you look at the consensus forward estimates for 2023, Wall Street analysts are expecting earnings to decline about 1% before rebounding 9.5% in 2024. On the right-hand side of that chart is a chart that just shows the forward multiple of the S&P 500 over time. This goes back about 25 years. And on average, the equity market has traded at about 17 times. At the bottom, it's around 10 times. At the top, it's around 24 times forward earnings. We're right kind of in the middle of that range currently. The reason why I wanted to show you this chart, and the reason why I wanted you to remember the 35% average decline for bear markets, is to just simply give you one heuristic, one way of thinking about how much of this is old news. On average, and it's just an average, but on average, earnings for the S&P 500 decline about 16% in a recession. There are times when the economy goes into recession when earnings don't decline. I've listed a couple of the examples in the commentary on that chart that you see there, 1970s and then in 1980. But on average, earnings decline about 16%. We're about 2/3 of the way through companies in the S&P 500 reporting their Q4 earnings. So we've got a decent read on the S&P 500 earnings for 2022. And I would tell you that that number is likely to come in around $223. That's for 2022 earnings. If earnings were to decline 16.4%, which is the average decline in earnings in a recessionary time period, that would imply that the earnings for the S&P 500 constituent companies would decline to about $186. If you then look at the right-hand slide and say, okay, if an average multiple of earnings is 17 times $186 would tell you that the S&P 500 should trade at around 3,176. Let's just round up and call it 3,200. That's about 20% below where the market's trading today. So if you ask yourself the question, is the equity market priced for a recession? I think based on this analysis, you could reasonably say the answer is absolutely no, it's not. If the S&P 500 was to decline 20% in 2023, and we know that the market was down 18% in 2022, that means that the market in total would be down 38% over the course of that bear market time period. I'd ask you to back up to the previous slide and look at what typically happens in recessionary time periods. And you can see that a 35% decline would fit with what would normally be expected with a decline correlated or happening in the midst of a recession. So as you flip forward, what I want you to see in this slide is simply the conclusion, sorry, one back, simply the conclusion that the equity market today is dealing with a push and pull of a service economy that is booming, a goods economy that is contracting. And in that uncertainty, despite some of the leading indicators that are suggesting that a recession is coming, the equity market today is priced in a way that would suggest that they believe that something better than a recessionary outcome is most probable. If we then go to the next slide, fixed income markets seem to be in the exact same, or seem to hold the exact same conclusion. This is a chart of credit spreads. So the incremental coupon or interest rate that investors require from companies, both investment grade at the top and high yield issuers at the bottom, in order to lend money to them, as opposed to just simply investing or buying a treasury. And those credit spreads over time, as you can see, have a pretty stable relationship outside of recessionary time periods. And those recessions are shown in the gray shaded boxes or areas of those charts. During those times, credit spreads blow out. And typically those credit spreads start to leak higher as investors increasingly anticipate a recessionary outlook. Just like what I showed with the equity market here in the US, looking at the S&P 500 and using consensus earnings and average multiples, just like the equity market, the credit market seems to be suggesting or priced in a way that suggests that a recession is not the highest probable outcome. You can see over the course of the last, call it 12 to 18 months, credit spreads rose as uncertainty around the outlook increased. But more recently, over the last 6 months, those credit spreads have pretty consistently tightened, inherently suggesting that investors are more comfortable with the outlook and think that recession is less probable. Which begs the question then, where is the best area for investors today to be invested, and how risk aggressive should investors be positioned given the setup in both equity and fixed income markets today and the uncertainty that we're all living with. And I would encourage you, now is a great time to sit down with your financial advisor, to reach out, make a phone call, set up a meeting, and make sure that the risk profile of your portfolio fits with your current financial situation and your outlook for what you think is most probable. For the Waterfront Balanced and Waterfront Equity strategies here at Waterfront, both strategies are positioned conservatively in anticipation or acknowledging the uncertainty in the economic outlook and the risks that the outlook could turn out meaningfully more negative than markets currently are anticipating. And so I continue to have a very conservative posture given the uncertain outlook, and anticipate having an opportunity to put cash and highly liquid, safe assets like treasuries, to take money out of those and put it to work in really attractive investments over the course of the next 12 months. As investors increasingly, in my opinion, come to appreciate some of these risks and price those more fully into risk assets, both on the equity and fixed income side. So with that, I'm going to close and thank you again for your attention, and I wish you all the best in 2023.